and I'm very structured. And so strategy and like being proactive and prepared is kind of like my thing. And so thinking of it more of like an art versus a science, it's very interesting, right? Because I think that you get to know your partners, you get to know their skill sets, and some of them already know these are the skill sets I have, and some of them are still discovering what they look
Hey
like.
there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm here with Paula Nichols. Paula is a real estate professional with experience in project and organizational management, investment analysis, and contract negotiations. Paula and her husband Jonathan began investing in real estate in 2018. So, Paula, I'm going to stop there. As I mentioned before we started recording, my voice isn't quite there. So, first of all, let me just say thank you for coming on the show today. I appreciate you taking the time.
Yeah, Jason, thank you for having me. I'm excited to be here.
Yeah. Looking forward to this conversation. Let's just start by getting your background. Tell us about yourself. Tell us, kind of what got you into real estate, and we'll kind of take it from there.
Yeah. So I was actually born in Colombia. And in 2006, my family and I moved to the United States with political asylum. And so we always had the dream to own a home. And when we moved to the States, a few years later, I became my mom's real estate agent. And so I was the one sourcing the home for her. I kept getting the mail over, and making sure I was signing up for all of the available homes. And so that was at age 15. That's where my passion for real estate really sparked. I was very genuinely good at finances and budgeting and doing all these things at an early age. And so later on, I decided to go to college, get a degree in finance. And that's where I met Jonathan. And I think that we got married in 2017, and we read about, real estate through many books, and that became our hobby. And it all started with a hobby that rekindled that passion for real estate that I had at an early age. And so late 2017, early 2018, we decided to make it, a more formal, not less of a hobby, more of a formal way of living and way of doing work. And so we decided to become full-time real estate investors after investing in small multi and single family homes. And so that's a little bit brief conversation, like brief summary of my story. But we now love multifamily. We've been working in Apogee Capital. It's the name of our company, or multifamily syndication firm. And we opened that early in 2019. And since then have been able to purchase, as GPs, over 400 units in Texas and Oklahoma. And we are really excited to continue to invite investors alongside with us.
That's awesome. Interesting to have that, sort of background at such a young age, working in real estate with, with your mother helping find house. So you were interested in finance, sort of sounds like right from the beginning. You went to college for that. What do you, as you and Jonathan were forming Apogee Capital, I think a lot of times people have, as you form partnerships, whether that's with, a life partner or business partner, there people are going to have different roles. So what was your role? What did you kind of take on, sort of what responsibilities have you had within the business?
Yeah. To be frank, it all started like it was commingled, right? We didn't have our own swim lanes. We were both doing everything together. And as we transitioned into making a business, we realized that, my background also, after doing finance, I went into management consulting. And so organizational management is kind of my thing. And it was multiple conversations with Jonathan of like, okay, you're good at this and I'm good at this. How do we stay on each other, like out of each other's swim lanes? And it honestly was a very organic transition, right? I thought that because I'm a finance major, I know like modeling, I know underwriting, like that I will transition to be that will be my main role. But in reality, Jonathan is an aerospace engineer. He's really great at numbers and he really enjoys the spreadsheets. And I really enjoy the business development, the relationship, more on the operations, system development. And so we've transitioned into that. He's more on the acquisition side. And I am more on the business development, investor relationships, as well as the asset management. And so I think that we both found our own strengths and also complementing each other. I think that we both have similar yet different personalities and skill sets. And so I think it has been very complementary.
Yeah, and I like how you sort of mentioned that at the beginning it was commingled, because I think that's kind of normal, right? In business, it's like a lot of times people form partnerships. They're like, oh, I like this person. I just want to kind of get into get into a deal. I want to do some business together. I like this person. Let's whatever it is. Even if we're not talking real estate, but then you find out what everybody's good at, what their strengths are, how they work well within the components. And so it's an interesting conversation to have. And I think so many people talk about you should have these conversations ahead of time and figure this all out before you get into a partnership with someone. And I think it's a little bit different when you're doing that with someone that you're married. But like, I also think it's probably hard to have it exactly laid out ahead of time, kind of in whatever scenario it is.
Yeah, it really is. It really is. And I think it's almost like a dance. And I'm very structured. And so a strategy and like being proactive and prepared is kind of like my thing. And so thinking of it more of like an art versus a science, it's very interesting, right? Because I think that you get to know your partners, you get to know their skill sets, and some of them already know these are the skill sets I have, and some of them are still discovering what they look like, as they apply it in the multifamily side of things, right? And so I think between Jonathan and I was a lot of leaning on each other, but also letting the other person shine. I think that as we have partnered with other people outside of, just Jonathan and I, we've learned that there are times to lead and there are times to follow and there are times to speak up and times to be quiet. And so I think that it's almost like a dance, right? You're going to step on each other's toes at times, but as long as you pick it up and you learn from that, I think that that's kind of the key to success.
Yeah, that makes a lot of sense. So if you're focusing on kind of investor relations and is business plan management, so that's you're talking really kind of asset management after acquisition, you're involved in that side of things.
Yes. And so kind of working with the property management to make sure that we're executing the business plan accordingly. So that has been a lot of fun. And we have a short-term rental business where I'm also involved in the operations of it, more on the kind of director level. And so I'm very distant from it, but it's really cool to continue to implement those lessons learned from our other business into our multifamily business.
Yeah, absolutely. How do you manage it in the sense, like there's a lot going on, people maybe that don't haven't done asset management before, and in short-term rental can maybe be even more involved because if you're having a higher level of turnover. But how do you kind of balance that and keep, you said you're sort of high level at this point, but what does your day-to-day look like? What does your role look like in all of that?
Yeah. So before I answer that question, my previous job to being multifamily, right? So I did management consulting and then I went to work for a developer here in the Dallas-Fort Worth area where I live. And in that, during those 3-4 years that I worked there, I got to work with a lot of asset managers at private equity firms. And so I got to see what they did, what questions they asked about our assets. And so it was, for me, very informative, and it was just a great educational process to learn from private equities and how they handle the asset management. And so again, I think that it is a part of science and a part of art, right? Like I am managing people, I'm managing the property management, and so I think that really setting the clear expectations of what those are and making sure that we together come void those expectations, and that there is that weekly accountability as of what reports are we going to be reviewing together and what changes are we making together. So we are a partner. And so I really like to engage in those conversations with the property management of like, okay, these are the expectations that we both are coming up with. This is the accountability piece, right? What happens if we don't meet those, milestones and expectations? And then on a weekly basis, let's review those so that we are both, proactively addressing any issues. And so I see it a lot as like a management, if you have ever led a team, it's having those kind of soft skills, but keeping it very, very clear, having reports, having spreadsheets to make sure that they're, that everything is clear.
Yeah, and I think that's a great point, but I want to, maybe you can get a little more detailed about, sort of what markers are you talking about? What, you said what these are the KPIs that we're trying to hit, that kind of thing, and these are the accountability points. What are you using for each of those really to have these conversations with your property management? Because I think this is like a lot of the programs, a lot of what you might see on social media, it's a lot geared towards acquisition, right? Acquisition or capital raising, which are incredibly important parts, but those are actually those are the short-term things, right? The acquisition, the capital raise, that might be 45, 60, maybe 90 days, but then the asset management is years. So what are you doing, looking at key KPIs and communicating to your property management? And then what are you doing for, sort of accountability steps?
Yeah. So to be transparent, on the first couple of these that we joined, we were not the asset managers. So it has been a really great experience to see how other people are doing it. And then recently we joined a master class to be it's called ACE operators. And so here we're meeting with all these other great operators to ensure that we are executing the latest and greatest strategies on managing multifamily. And so I think that I want to clarify that to everyone, that there is always room for improvement. And so for us, executing the business plan is so important, because as you said, if we focus on the acquisition and then the business plan is not executed, you're not going to be able to get the returns that you had projected at the beginning of the project. And so for us, the KPIs that we look at are, most people probably know, occupancy, and then the lease up, right? The turnover, how long is it taking them to turn over the units? And then I would say that for us is what retention we have, right? So we want to be able to retain as many people as possible. And so really coming up with creative ideas on having events on a monthly basis so that we're creating that community. A lot of our why at Apogee is to be able for people to leave their calling. And so we want that for our residents as well. And so how do we create that sense of community in a way that it benefits them, because they don't have to move, they get to kind of set their roots here. And then also for us, it helps us because we don't have to turn over units as quickly and spend all that money on CapEx. And so it really looks like an hour meeting on a weekly basis and going over these specific KPIs, right? From an occupancy perspective, turnover, delinquency is one of them too. In our current property, we don't really face a lot of that being an issue, but I do know that it is an issue in other projects. And so I think that going over those key numbers are very important, and setting goals. And so, for example, if right now you are at 80% occupied, let's set a goal that's attainable by next week, right? So maybe it's not 100% by next week, but it's 85. And so how do we get that? And really, I get into the nitty gritty, what are we doing to get, we have 40 units that need to be leased. What do you need from me? I've thought about XYZ. What have you thought about? Okay, let's implement it. Do you need flyers? Do you need whatever it is that they need? It's how can I help them? But also I'm going to hold them at a high standard, because we do need to ultimately execute on the business plan.
Yeah.
Does that answer your question?
Yeah, no, that's a great start. I will expand, because I think these are really important points. But your point about resident retention, and I think it gets, kind of overlooked. And there's a balance, right? Because uh, you want to retain residents that are, they're paying on time, they have a good relationship with the community, that kind of thing. You want to retain residents, but there's also that balance of, well, if these particular units are well under market rent, how are you going to decide how much to increase on a renewal while still retaining that good? And I think you said before that it's an art as much of a science. How do you balance that? How do you kind of look at retention and occupancy and kind of bring that all together?
Yeah, I really think that it depends on what phase of your business plan you're in. So if we're just starting on a property and our, day one of execution is to bring rents up by $200 because we're going to be doing renovations on all of the units, then that means that unfortunately we're not going to be able to renew the leases as they expire, right? And we're going to try to, in a way that works with our property management and GC, we're going to be able to phase them out so that we can have the time to, turn them over, do the CapEx projects in the units, and then lease them up. And so if it's at the beginning of the business plan, and that's our business plan, is to completely renovate the interior of the units to lease them at a higher rent, which is a very standard business plan in a value add multifamily deal, then we're probably not going to want the residents to stay at least at the same, unit. And so what we offer is like, hey, if you love this community, just so you know, you maybe move to another unit in the meantime while we renovate this unit and we bring a new resident to live in the new unit with the updated rent. Now, in one of our projects, a complete marketing strategy wasn't to renovate the interior of the units. It was that when we purchased it, the market rents were quite low because it was being, ran by like an individual. And so we just enhanced the marketing of that property and just very organically were able to bring rents up. And so in that case, we wanted some people to just stay and be okay with the increase in rent. And we did. We had a good, I think, like a 30-40% retention. And for us, that was a win, because when you're going to be, your rent is increasing by $200 and you're not really experiencing a benefit, most people are going to be like, oh, I'm okay, I'm going to move. And so it really depends on your business plan and the phase that you're in. But ultimately, once you hit the rent growth that you wanted, you probably want to keep them, right? Like year 2, 3, you want them to stay, so you're not having to turn over those units all the time.
Yeah, it's a great point. It's interesting, you mentioned the partnership dance, but I think this is a similar thing where you're absolutely right. Whatever phase you're in the beginning, sometimes the business plan is to kind of go in and renovate as many units as you possibly can to, sort of really bump those rents up. But over time, you want to stabilize it and keep that balance there. And it does depend on the project, and it also depends on probably the market cycle and the
month of the year. That's important too.
Right, exactly. Yeah, because the leasing, not a lot of people want to move in like December, January time. So
right.
It's not a great time to sort of get everybody out, because you're not going to be able to get people back in. So you do have to look at a lot of different factors. And I always look at asset management as kind of 3 different components. There's that, sort of construction management. If you're doing a value add project, like you mentioned, there's the leasing side of things that we've been talking about here a little bit, as far as how to balance that. And then to me, the third part is just that the financial component, the financial modeling, and that's really what connects the 2 sides, right? It's like you're spending money to improve the property, but you've also got to figure out, through your leasing, how to continue to generate revenue and ideally sort of decrease expenses overall. So,
right. It's like a really domino effect too, Jason, just to corroborate what you're saying, because if you're just in the construction side and you're like, well, I think that this, unit is going to look beautiful if we put backsplash and new countertops and all of these beautiful things. And I love interior design. Don't get me wrong. I want to make a product that's beautiful, But if you put all of these finishes that do not match your community and the type of resident that you're attracting, then you're not going to be able to get those rents, because that's what your comps are not putting that, right? You're not going to be able to get those rents or that premium that you need to support those improvements. And you have to remember that the money that you're spending on these improvements, it's equity or debt. And so you're paying interest, or you're paying, revenue to your investors. And so you have to make money in whatever you're putting into the unit. And so I think having that financial mindset as well will help you choose the right finishes and communicate that to the construction manager, and making sure that they have a timeline as of when they're going to complete that. So
yeah, no, I completely agree. I think that it's easy to get caught up in, oh, I want to make everything beautiful and top of the line, and if I do that, then that'll mean that our rents go up, X amount of dollars. But it again, we mentioned it, there's a lot of factors that go into it, and so you may not be in a location that supports, backsplashes and ceiling fans and whatever, things you might see, the nice stuff that they do on HGTV. Like, it's not, you have to remember, it's not a custom home building project. It's a value add, multifamily investment portfolio. And so there is a different approach to that. And so do you do a lot of testing in terms of, level of finishes with how do you decide, I guess, how much, how far to go with those renovations?
Yeah, no, that's a great question. I think that one, it's comps. Again, you definitely don't want to just copy paste what your competitors are doing, but you definitely want to walk the competitors to understand what are residents appreciating, and what are they willing to pay for X. And so I think walking those competitor company or properties will help you understand what the standard is in that area. But we have had the luck that in the other property, in our previous 3 deals, a lot of them had proof of concept already before they sold. And so we kind of knew what the premium finishes would look like in our units, because they had already proven that concept. And for us, it made it a very safe investment in a way, because we had proof not only from our competitors, but within our own building, that we were already leasing for a premium if we brought it up to X finishes. And so we had that going for us.
Yeah, that's a great point. Sometimes it's already been sort of proven out for you when you take over, or maybe even better, you've got multiple assets in a market, so you kind of know what you're doing. If you're, doing these projects at one asset, what's happening, the resident base, what it costs you to get these, units completed, and now you're buying locally again, you're essentially creating your own comps. And I think that's a really great position to be in, and why a lot of people might, sort of focus on a small number of markets.
Yeah, and one example that I can think of is we have 75 townhomes in College Station, Texas, built in 2012. And so if you were to go look at the map, they have, granite countertops, that very nice, but it's like brown wood cabinets. And so it's a very nice property, but if you look at it, it's starting to look outdated, because it looks like 2010s and not 2023. And one exit strategy that I was discussing with Jonathan is how do we elevate one unit, make it look more modern, and as we get ready to exit. And so again, that's more like a futuristic goal, but whenever we get ready to exit, I would love to test the waters to see, if we improve, if we make it look fresher, can we increase our rents, and in a way set that up for the exit strategy. And so
so then I think what you're saying is you're effectively doing what we just talked about for the next owner, right? You're demonstrating, okay, here, if we do this, you bring it up, if it already has solid surface countertops, maybe you're now going to reface the cabinets and paint them or something like that, add a backsplash, whatever it might be, to that next level, modernize it, and then say, okay, what are we able to get for lease at, what
Yep.
how much of a premium are you going to get for that unit, and then say, okay, now here, if I sell this, you'll be able to do that in the remaining units and achieve the same thing.
Exactly. Because then at that point, you're selling the opportunity of value to the next buyer. And usually, I mean, probably not this year, but like 2 years ago, that was probably baked in your pro forma, and people would be willing to pay for that opportunity, to come in. And so that's just some kind of thoughts I've had on that specific property.
Yeah. And the point that you just made, Paula, about 2 years ago, people would have they would have paid for that kind of in advance, and probably not the case right now. So I think it's a good point to talk about, kind of where we are in the market cycle, maybe some of the shifts that you've made in terms of, business plans, exit strategies, that sort of thing, and how that looks, sort of for the future. I'm not asking you to predict what happens with the market, but more like what do you see, has your strategy changed, and how do you see it going, in the coming year or two?
Yeah, I think like retrospectively, the one thing that I keep telling my friends, investors, and partners is like debt is a sharp knife. And so, the past 2 years, people were using bridge loans, and that seemed to be like the big pain point for a lot of deals today, right? And so now with the interest rate rising and, it becoming harder to refinance at a more decent interest rates based on their underwriting, I think that has caused a lot of challenges to a lot of operators. For us, we have been lucky, blessed, however, where all of our deals were on fixed debt. And so that helped our DSCR, be met without issues, and all of our properties are performing, to or up, above pro forma. But I feel like we're seeing a lot of operators being challenged with the interest rates piece. And I mean, many of them are friends of mine too. And so it's how are they going to be able to react? And a lot of people, so lenders and different, folks have said that there is a wave of opportunity coming up at the end of this year or beginning of next year, where some of these loans will be due. And unfortunately, sellers will have to sell at a discount in order to not get foreclosed on. I don't have a crystal ball. I cannot tell you if that's true or not. But I think that there is a lot of folks kind of standing on the sidelines waiting for that wave to come in. Sellers today, based on their loan terms, are still able to say, no, I'm not going to give you a discount. Not yet. I'm going to wait and see. And so I think that we're in this kind of weird situation today where we're just, waiting for the right time. I will say that for us, we pride in being very conservative. Probably, some folks may say like too conservative, but we pride on being conservative just because, again, a lot of our investors are friends and family, and we want to make sure that preserving capital is like our number one goal. And so we see opportunity coming, and we're hopeful for that opportunity. Deals are harder this time, to be frank. And so we haven't, we closed a deal a couple months ago, but we're actively looking for the next. And so that's kind of what I see, or what I've heard at least.
Yeah, no, I agree. I think there's, the debt being a sharp knife, that it's a great point, because that's been the real thing, right? That's the source of pain here, and opportunity due to that pain is what people are talking about, is because essentially if your debt is coming due now, and especially if it was short term, and so you bought, a year ago, 2 years ago, and on bridge debt, you're going to have some probably difficult decisions to make here, in the next year. And it's, if you can figure out a way to ride it out, then, again, real estate is a long-term play. So you don't necessarily, it's like when the stock market goes down, right? You don't you
Right.
don't actually lose anything unless you sell. And
Right.
so, you hang on, and then it comes back up, and it goes above and beyond where it was before. So it's kind of like that. That's what a market cycle is. And so it's just being, I guess, in the right position, and it makes the point of how important debt is. And a lot of people, all of that bridge debt that's out there, it isn't because that's what people necessarily wanted to do. It's because that was kind of, in a lot of ways, the only way deals were getting done. There was, just because of the market cycle, it's, we had, I think, I've heard anywhere from 80 to 90% of the deals that were being done were done on bridge debt. So
Yeah.
it is very lucky if you got in, long-term debt, and at a low interest rate, and now you have the opportunity to sell as an assumable loan. So I think it's taking things like this and like learning those lessons, that's the best thing that you can do.
Yeah. Yeah, I agree. And for us, just as we're, in this part of the cycle, we actually passively invested in a deal where, they had a bridge loan. And that was very, very early in our multifamily journey. And we were so excited because we knew of this person and we knew of this operator, and we looked at the numbers high level, and we didn't think about the bridge loan, the impact that it could have if interest rates rise. And so we actually are putting together like a one-on-one class for passive investors so that they can ask the right questions before investing passively. And so we're launching that class in October 16th. But as part of that class, there is an article that CBRE posted in 2020 that talks about like how to protect yourself on a downturn, cycle, and it's specifically for value add. And one of the recommendation is, make sure that when you're looking at like your debt, that you're cash flowing, that you're covering the DSCR ratio substantially. And so I just think that there is a lot of lessons learned, that if we can keep them at the front of our mind, it can ensure that we don't, fall for that again, or that we are more careful, at least recognizing the risk before going in. So.
Yeah, 100% agree. We had, and the last few years have been, a number of sort of once in history type of things. We had a pandemic. We had the interest rates have never risen this much this quickly ever in the history of the history of interest rate. I don't know exactly how to say that, but so a lot of things happened that would no one would have seen coming. But
Exactly.
But if you look at it from a very basic standpoint of, well, knowing that this has happened and things that you never saw coming came, then you can, use that information going forward in, future deals, and use that to continue to have success in real estate. So I think that's a really
100%. And to allude to your why, Jason, right? Like we all are individuals with different risk appetite. And let me tell you, some people who invested in bridge loan deals did extremely well, right? So it doesn't mean that bridge loans is, a bad word or something like that. It's just sometimes we don't get to time it the way that we want to. And so many people, made substantial amount of returns through bridge loans. And not only that, I strongly believe that multifamily and real estate continues to be a great, tool to grow your wealth. It's just what questions to ask, right? To kind of lessons learned more to carry on.
Yeah. You just need to understand what in that. It's a great point. Lots of people made a lot of money on, using bridge debt. And if you don't have bridge debt and you have a long-term loan and you want to exit early, there's a fee. So it costs money to exit unless you can have it. So it's not as simple as, I'm glad you said that, because I don't want people to think like, oh, you should just never use bridge debt. Like there are reasons to use it. And it's just being kind of aware of what the potential consequences are. That's really what it comes down to, and really understanding the market cycle, your project, all of how it all ties in together is so important. And then just recognizing that the idea is that real estate is meant to be a long-term investment. So, although people made a lot of money in a short time over these last few years, that is not the norm. And that's not really what we should expect. We should expect to have these up and down cycles, and we ride them out so that we can kind of succeed on the long term. So I think that was a great point about people have been very successful with bridge debt. So important things to understand. Paula, let me switch gears. I want to get to ask you the questions I like to ask every guest. The first one is, of course, based on the name of the show, but what is your why? What's driving you, towards bigger and bigger success?
Yes. So if you know me, I'm actually like a really passionate person. And I don't know if it's because I'm Colombian and that's just like, oh, my family's passionate, but I remember being in corporate America and a lot of my mentors asking me like, why are you so excited about this? Like, what are you going after? And I'm just like, I don't know. I wake up every morning and I want to be passionate about whatever I'm doing. And I think that it took me a few years to really identify what my calling was. And, you may call calling your why, your purpose. But once I identified my purpose, I wanted to make sure that I dedicated my life to pursue my purpose. And so, at Apogee, part of our mission is that we exist to empower people to pursue their calling. And so in our case, for Jonathan's and I, purpose is that we want to share this opportunity of multifamily syndications and real estate investments so that people can have the resources and the time to go pursue that calling without any limitation. And so I feel like that is our big why. We like to do that while having fun. So, Jonathan and I are about to go travel to Europe for a month, and we're going to work remotely. We like the freedom that this job gives us. It gives us a lot of stress at times, but it gives us a lot of freedom at times. And so that really is our why.
Yeah, I love that. And it sounds like an amazing vacation. So enjoy that. Tell us something about yourself that isn't common knowledge, special skill, a hobby, something to let listeners know you a little better.
That's a good question. I guess a fun fact, I was raised in Colombia, as I said earlier. I hated English class. I was great at all the other classes, like, math and science and whatever, but English was the hardest thing. And I remember talking to my parents and being like, I'm never going to use this. Why do I have to learn English? And it was really hard when I moved to the States. I was 12 years old, and it was definitely a challenge to adapt. But I would like to say that I am now fluent. It took many years. And so I don't know, I think that people don't realize how hard it is to learn a new language. And for me, it was the biggest hurdle when I moved to the United States. So
I mean, your English is excellent. So I'm surprised by that, but yeah, I do recognize how hard it is to learn another language because I don't know one. And so I always feel like I would like to learn other languages, and it's super challenging, especially if you're not learning them as a child. I think child brains are more able to kind of accept new languages and things, but yeah, I wouldn't have expected to hear that you had a problem with that based on this conversation. So when people hear this and they want to reach out to you, what's the best way?
yeah, so we have a website, apogeemfc.com. I actually briefly mentioned it before, but we have a class launching on October 16th. And so if you would like to come and watch our class, it's going to be super fun, super short and informative. And so you can go to our website, apogeemfc.com, and then our emails can be shared as well. I'll share it with Jason so he can put it on the notes.
Yeah, and we'll put all that in the show notes. And I think it'd probably be pretty good timing as to when this episode will come out. Will be right around the time that your class goes live. So that's awesome. Final question for you, Paula. Excuse me, sorry. Final question. What piece of advice would you give to someone who is wanting to get started in real estate? They hear this, they're inspired by your story. What would you tell them to motivate them to get going?
Learn and take action. I know it's kind of two, but I would set a timeline of learning. Okay, I'm going to learn something for a month, 4 weeks, X hours a day or X hours a week. And then say, after those 4 weeks, if I have all my answers, all my questions answered, I'm going to take action. And that action can look small action, big action, just take some sort of action and invest. I think that all of the investors that I know, their only regret is not investing sooner. And so, go ahead and take that big leap of faith.
Yeah, that's awesome. It's true. It's true. If we could all go back in time and invest in 2010, we would be we'd be in a really good place right now. So thank you so much. Thank you for coming on the show, sharing your story. I really enjoyed this conversation and appreciate having you.
Yeah, thank you, Jason. I had a lot of fun.
Awesome. And folks listening, I'm sure you're going to get a lot of value from this episode. Please connect with Paula. We'll have everything in the show notes, and please like, rate, and review the show so we can get more great guests like Paula. Thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?